Investing should be practiced by professionals because it is a professional occupation. It's a full-time job where you have to make these sorts of calls, which require judgment. And judgment, in my opinion, is nothing but the cumulative experience married to some skills and knowledge and information that you pick up along the way. And I think that, therefore, people who believe that an academic degree is going to help them become a better investor, or just being well informed, on a given day by reading a magazine or by listening to an interview, that's not enough. It may be a good start, but that's not enough. What really it takes to invest is you need to surround yourself to understand the business from the inside out, not from the outside in. And that means a deep domain knowledge of what drives that particular business. So when we did research on, say, Toyota. Now, Toyota is a company that you think is so well researched. Where is the information advantage to be procured in researching a company like that? Well, guess what? A lot of people misunderstood what was going wrong at Toyota, including Toyota itself. But the job of Toyota's management, when there was a management change, was to figure out, to take advantage of the crisis. Toyota had faced many problems, including some of the quality issues in their components and some acceleration of brakes, etc., which they were exonerated on. They were never at fault, but they took, and the downturn in the auto industry, etc., worldwide, they took advantage of that to reset the business on the right path. In particular, one of the things that few people talk about in Toyota is that the CEO of Toyota, who is the grandson of the founder, but of a very different type, he is a big believer and actually is a professional test car driver, race car driver. So he actually tests every new model to see what is the feel of the drive. Before that, Toyota was all about durability, reliability, factual metrics, but not the soul of the car, where the German engineers, where the German designers, the Italians, with the Lamborghinis and the BMWs, was sort of stealing a silent march. And the consumers were evolving in that direction where the look and feel of a product was as important as the functionality of the product, as we know with some of the devices we use today in technology. And I think Toyota understood that. Now, that kind of an insight you only get, and we actually researched and found a lot of interviews with the CEO. Very few people go around looking for, what has the CEO said, because not too many people get an audience with him, and neither did we. But by hearing how he was trying to get Toyota from where it was to where it needed to be, a lot of people talk about the cost cutting at Toyota, how they were going to relocate some factories and how the yen was hurting them. Well, that is information that everybody had. What we had was an understanding of how they're going to pivot the company to position it for the next decade or two, both in emerging markets where they needed a value engineered car, but in developed markets where they needed a car to move more upscale. So then they relaunched their hybrid technology. Now, this company always had strengths, but how you apply your strengths is more important than just having them. And I think this is the kind of surrounding of the research where we are trying to find out, what is different about how we understand this company's positioning, where we understood that by introducing this new technology, they would be able to differentiate themselves from the conventional view that Hyundai, which was coming in at the low end, would be able to steal a march on Toyota. We were able to rule out that threat because Toyota was moving more and more upscale in terms of the technology deployment in the cars. And Hyundai would not be able to catch up because to invest in hybrid technology takes decades, not just years. So this is the kind of investment research that I think an investor has to do, and we certainly do it on all different companies. Then we would talk to the suppliers of the company. Then we talk to the competitors. We try to understand at 360 degrees on that company before we even get to what I call the financial model of the company. Everything I've talked to you about right now is the business model of the company. What drives the business. Then we look at what are the numbers behind that business. Too many people start with the numbers first. Numbers are telling you, what's history. They're not going to be telling you what's going to happen in the future. The future is a business strategy. That's where we start. Then, having looked at the business strategy, we say, do the numbers make sense in the context of what we understand about the business? And then finally, even after we've done these two things, business model, financial model, we then look at the valuation model. What is the market telling us about the risks that this company is exposed to? What is the market telling us it's going to pay us to absorb those risks? And when Toyota stock price fell 60-70%, when everybody was concerned over the risk of it losing market share, of the yen causing it to lose its margins, of it losing market share, the threat of new competition, it was paying us for all those risks. And I think that is the key to investing. Knowing what risks you're taking, but also checking whether you're paid to take those risks. Once you have those two things figured out, investing actually becomes fairly straightforward.